Morning, everyone. Thank you very much, first of all, to the Securities Commission of Malaysia for having me here. And I'd like to give a very warm welcome to Eli, straight out of NYC to KL. Let's give him a round of applause, guys. It's probably a 20-hour flight or so. So first and foremost, I think it goes without saying, Betterment led the charge with respect to passive investing via technology, I think circa 2008. So I was very curious, perhaps for the benefit of the room, to understand a bit about the origin story, because I think that's pretty much what is always very exciting to essentially an audience of entrepreneurs, to understand the backdrop by which you founded the company when there was a bit of a, I would say, boo-hurrah in the US because of the GFC and perhaps a flight of capital away from equities, perhaps a flight into cash, into taking out and putting it in your FD and all that. So perhaps, Eli, could you give us some reference of your frame of mind when you started the company with John?
Sure, happy to. Yeah, I love a good founding story. I think it's so important to understanding companies, and I think that founding story and the origination of the vision of the founders, that embeds itself in the DNA of a company, and it stays with the company, really for its history. Really, our work at Betterment, it predates the financial crisis. So I referenced 2008, but in reality, we actually started working on Betterment in 2007, and we formalized in 2008, just shortly before the financial crisis, before we knew it was coming. And so what we observed was really in the context of a long hangover from the dot-com crash of the early 2000s. We had seen during kind of internet or Web 1.0 era, that there had been great proofs of concept for consumers moving their finances online. They wanted their financial services to be online. And a couple of the examples that we looked to were E-Trade, which was a proof point that people wanted to trade stocks online.
Yep.
And then all of the big trading firms were moving their operations online. And then ING Direct, which launched a branchless, online-only bank in the U.S. with a super simple value proposition. It was higher interest rate on your savings, and it was very, very easy to understand for consumers. We don't have any brick-and-mortar branches, so we can pay you a higher interest rate because we have lower overhead cost. So we thought that was really interesting, right? But we didn't think any of that was really addressing the core issues and problems for most investors, which is, what do I do with my money? Can you just solve this and figure this out for me? And I had been working as an attorney, and from my vantage point, I had spent a lot of time actually working with executives, C-suite executives at large firms, and helping them with their compensation packages, and seeing the full suite of services that really wealthy Americans receive to manage their finances. It's white glove. They barely have to do anything, and it's all optimized. And I think part of what we thought was, how can we provide that level of service to customers at scale? And we really felt strongly that we could use technology to automate and make more efficient many of those processes and make it accessible to investors.
I see. So that's really interesting because when you were working on it in 2017, I suppose that coincided with one of the biggest shakers with respect to mobile app development, which is the introduction of the iPhone.
Yeah.
So I suppose, was that something that you understood in the background was happening with respect to hardware and the ability to access apps?
So I mentioned in my talk, learnings, shared learnings,
Yep.
shared successes, sharing missteps. This is in the category of missteps. And our missteps created opportunities for other companies like Acorn. So we really ignored the iPhone. It was not yet apparent that mobile was going to dominate the way that it did. I really think we started working on Betterment within a month or two of when the iPhone was released, give or take. I'm not even sure which way it went. So we were entirely web focused. That was effective for a while. It then eventually caught up to us. Even when much of the world was starting to see and demand services mobile, and they were becoming mobile first.
Mobile, yeah.
which was, fast forward to 2012, 2013, we made decisions to deprioritize our mobile app and emphasize our web app. And it's a constant challenge for tech companies. Today you have to think about, are we mobile first? Are we mobile only? Are we web first? You can really not be web only now.
Yep,
it's really not possible. It's not a sound business decision. But for companies that need to serve both mobile and web, it's difficult to resource those applications and have them both at parity.
Oh, wow. Fantastic, great. So it was in spite of what was happening in hardware.
It was in spite of, and it was in spite at first of what happened in the financial crisis. We were fortunate. We were in development mode when the financial crisis hit. We thought we would launch much sooner. We thought, being naive first-time tech entrepreneurs, that we would build and launch a product in 6 months and the regulators would approve it in 6 months. And after 6 months went by, we then started another 6-month plan. And then after that 6 months went by, we went on to another 6-month plan. It took a long time. And it actually worked out to our benefit because we were able to wait out the financial crisis a little bit. Things had stabilized, and we launched at really a very ideal time.
Right, all right. So can perhaps, since we are at a regulatory-driven initiative, perhaps we could have a sensing of what was the regulators' perception of a new tech startup focused on asset management, such as Betterment, I suppose. How did the SEC and how did FINRA see it?
Very different from how they see it today. To go back again to something I mentioned in my talk, fintech was not really a recognized, defined space. So we were looked at as really just another company that was offering investment advisor and brokerage services. We happened to have it. We had a website. A lot of companies had a website, but there was no such thing as a robo-advisor. That term hadn't been coined yet. We were doing this for the first time. And so we just went through kind of a normal process with a little bit of head scratching about how this was going to work online. And I think if you look at it today, right, FINRA and the SEC, much like here in Malaysia, they have a lot of initiatives to help fintech companies ramp up into the regulatory environment.
Engage early on, I suppose, prior to them launching the MVP? Is that what you're thinking?
We really didn't understand what we were doing. And so we tried to explain it, but it's hard. It's abstract. If there's no examples like what you're doing that are in the world that you can reference and say, well, it's going to work like this, but with a little bit different. We were completely abstract, and we were building, so we didn't have much to show them. Eventually, as we were seeking permissions, we showed them a prototype of the website, and that helped shed some light. But it's hard on a regulator to understand a concept that's totally abstract and really brand new.
So I suppose on the backdrop of that, because for a lot of startups, the idea is to have an MVP, and that's what you use to go to regulators, that's what you use to raise venture funding. So perhaps from your perspective, when you were founding Betterment, which one came first? Was it chicken and the egg? Was it raising venture funding to build an MVP or getting some regulatory steering?
So we actually... we bootstrapped Betterment for about the first 18 to 24 months.
Wow.
We were living off of some savings. It was a really small team. It was just 4 people. So we didn't pay ourselves anything, and we focused on building the early prototype of the website, of building the back-end systems. We didn't talk much about this, but Betterment is a pretty deep stack fintech company. We built our own brand new proprietary broker-dealer that custodies the assets. It's a really big deal. There's not a lot of full-service custodial broker-dealers that come online, and there certainly hadn't been at that time.
Yes, definitely.
So we focused on the building, and we got something launched. We were able to attract our first 500 customers or so from our launch event, which we did at TechCrunch, and then we were able to raise our first venture capital a few months later. I think we really needed to have proof of concept. I don't think that the VC industry was ready to put money into something that hadn't received regulatory permissions at the scale, at the level that we needed to.
Right, okay. And I suppose as a founder yourself, because your background was as a corporate lawyer, so I suppose, how was the transition from going from essentially your vocation into something completely unknown, such as tech? Because I think that's a question that plagues a lot of founders, non-tech founders in the room, where they want to go into the business, but they don't necessarily know how to start the business.
Yeah. Well, I ate much less well than when I was at the law firm, and I had a expense account and corporate dinners and things like that. So that was,
It's a sacrifice.
that was too bad. I think what I'd say about this, right, is when you're at the early stages of a company, everybody has to have some skills. Everybody has to be an athlete and be able to take on various tasks. And for a company like Betterment, we had little capital, and we had a lot of legal work and lifting to do. And so for me, that was a big part of how I was able to contribute and how I was able to lower costs. And later, as we scaled, I took on operational management functions. I was not a coder, right? I think in most early stage tech companies, there's not a lot of room for team members who can't do some software development, some web development. There's a little bit of room, not a lot.
Right.
Betterment was a special case because there was so much legal building to do. I sometimes call it legal coding, right? I had to write a customer agreement that had never been seen or done before. Had to write operating procedures for the broker-dealer that had never been written before because there was no sort of automated online financial advisor. It didn't exist. So that was my form of it. And I think, I think that remains the case, right? You got to bring some hard skills to the early stages of a company.
Oh, it's amazing, really, to be able to go from essentially legal vocation into tech. I think into essentially a new business model that had not been trialed before in the US, I suppose. Yeah.
And there's so much to learn too, right? I was naive about everything, in terms of company building. How do you devise culture? How do you spread culture, right? And we learned that on the fly. When we were 4 people in an office, culture was natural, right? We brought our own personalities, and that created the culture. And there was no need to disseminate that culture. And there was no need to disseminate information about what people were working on because we were this far apart from each other. So I could see what was on your computer screen. If my colleague had a phone call, I could hear one end of that phone call. I knew everything that was going on in the office, and everybody else knew everything. Now, as you start to build the team, now there's 8 people, there's 16 people, there's 32 people. Well, then you have to think about how do we disseminate information so people know what's going on, and how do we divide up responsibilities because everybody can't do everything. So you think about things like that. You think about how to delegate and how to build redundancy, and you learn about marketing. I knew nothing about marketing. I had to have, after we launched, our earliest people who were working on marketing explained to me what search engine marketing was and what search engine optimization was. I heard the acronyms SEO and SEM, and I didn't know what they were.
Yeah. So it's more, was it more digital or more on the ground marketing? What was the scene like in New York City then, with respect to tech products going into the market?
It was largely digital, I would say. The sort of the ground tactics. I think we understood that those wouldn't scale. In those early days, so thinking back 2009, 2010, 2011, some of the big fads, if you will, in marketing growth were gamification.
Yep, that's right. Yeah.
Right, so everybody who would come into the office to learn about it, say, well, this is really interesting. How are you going to gamify investing? Okay, I don't know, maybe we should. Social was really big. So how are you going to make this social? We had an early feature where you could share all the information about your Betterment account with your Facebook friends because that was what everybody was doing to create growth. It was a terrible idea. Thank God we had some semblance of common sense to user test this, and people said, that's really interesting if maybe you're buying clothing.
Yeah, or Foursquare or something.
Yeah, but this is not something that people do not want to share information about their investment accounts or their savings with their friends. So we killed that feature. And then virality was this idea, right? There had been some companies that had just gone viral. So what's a growth strategy? We're going to have a viral growth strategy, which thankfully we heard some smarter people say. Every time I hear an entrepreneur say, we're going to have a viral growth strategy, that's the same thing as saying to me, we have a no growth strategy. So we relied on some more tried and true. Like I said, SEO and SEM. It was the early days of social. It was really predated social,
Right.
but it was digital.
Wow, that's interesting.
Yeah. And then the other piece that we learned, slower than we should have, but fast enough, was about content and thought leadership. And I think in a vertical like financial services, showing thought leadership, having great thought pieces, having leaders affiliated with your company who have credibility, that's really important. And then also social proof, right? Having influencers who write for independent publications, write about your company, being in major publications, being on television is important, and finding ways for your customers to talk to their friends and say, oh, I use Betterment. It's great. You should check it out. Those things are really important growth strategies.
Right. So evangelism is as much part of the essentials for building the company, essentially.
Yeah, and we see it. I see it today with the fintech companies, the newer fintech companies that I work with today. If they're consumer focused, I think the strategy of content, of customer referrals, of organic forms of growth is critically important.
I'd like to dovetail a bit into team dynamics, if I may, because the topic that you spoke of a bit earlier was very exciting for a lot of the tech startups who get out the gate, get the MVP done, raise the seed funding, and then go to Series A. But once you start scaling beyond 20, 30 men, then a lot of employees you start to hire, and a lot of these guys just take it as a 9 to 5 or 9 to 6. So I'd like to understand, perhaps from your perspective, when you were growing the team from 20, 30, 40, 50 people, was there a true north that you guys were aligning under? How do you motivate employees, employee number 30, to just go for it as you are?
Well, it's a great question. I love that question because I do think, there is something about that drives people who are the very first to join a startup. That is, it's just in their blood, right? They want to join something that's at the earliest stages and build, and create. And you almost don't need to motivate, right?
Yeah, it's a bit of an anti-establishment tendency, perhaps? Is it a bit of that?
I'm sorry?
A bit of an anti-establishment tendency?
Something like that, yeah. And, I remember having, a couple early employees who that wasn't for them, right? They, maybe were coming out of more 9 to 5, maybe even 9 to 7 type jobs, right?
That's right.
And they recognized it, right? They stepped out after short stays and said, I don't think this is the right place for me. As you get a little bit bigger, as your question sort of astutely gets at, it just doesn't function that way. There is a point at which the organization gets a little bit bigger, and you have to accommodate different types of employees. They're not all gonna sacrifice everything in their lives, go home at midnight every night to build a company. So I think, a few things. One is it's really important to communicate to the team what the mission of the company is. Why are we here? What's our vision for achieving that mission? And then tie that back to clear objectives, a couple clear North Stars. So for Betterment, in the early years, we talked about AUM, and we really set that as the goal, and we tied it into compensation structure. You have to do that, and I think you have to give employees authority. You have to give them responsibility. You have to give them ownership. Make them a part of setting the mission and the vision. Include them in that conversation. It's not a democracy, right? Running a company is not a democracy. You can't do it by consensus, but you want to include your employees so they have some ownership in it. And finally, incentivize them that way as well, right? Give them equity. Make sure that they're going to share in the upside of the company.
Right. I was just about to get to that in terms of the importance of having skin in the game, I suppose, for a lot of these guys. I assume quite a few of the guys that started with you might have stayed, I suppose. Yourself, John stayed, of course, co-founder alongside yourself. But how much was equity versus financial compensation? Is it a mix of both, depending on C-level? It's not exactly a science, I suppose, right?
Yeah, listen, I think getting compensation structures right is the table stakes for retention, right? If you don't get that right, then you're going to lose people. They're going to feel like they're not being treated fairly, or they're just going to have a wandering eye and go find another opportunity that gives them a greater financial upside. So you got to get that right, and it takes a lot of trial and error, frankly. I mean, we've tried a lot of different formulations. I mean, it all sort of is some mix of cash compensation, bonus structure, and equity structure. But we've played around with that and pulled those levers different ways over time. And as you get bigger, the equity upside naturally has to come down, right? The valuation when we first raised capital at Betterment, the valuation was like about $8 million.
Yep.
When we most recently raised capital, it was like just a little shy of $1 billion. So there's been a lot of value created. You can't give as much equity to later stage employees, and you have to ramp that up with more capital, more cash compensation.
Especially as you're in the market for mid-career professionals and the likes. Right?
Yeah, and as you scale, you need to bring in different types of employees, right? The builders who could do a little bit of everything in early days, right? Or really work, be great individual contributors. They may continue to evolve and grow with the organization, or it might get to a point where it's no longer the best fit for them, right? And they need to go on to other challenges, and you probably need to bring in people who are more accustomed and more of a fit for a large organization, and there's then probably a change in the compensation mix.
I see. Okay.
You got to continue also to re-up people on equity. It's something really important that we've done at Betterment from the early days. And if you're an entrepreneur out there who's not doing this, when employees come in, they get an initial equity grants, and it's a standard sort of 4-year vesting schedule. But a year and a half in, we start to give you regular top-ups annually, a little bit of extra equity, so that you continue to have more that you're vesting in. We call it an evergreen program, if you're not familiar. And it makes sure that you don't reach a 4-year point and fall off a cliff and you say, okay, well, I've vested in all my equity. I'm going to go look for another opportunity.
I see. Right. Okay. Well, that's very, very insightful hearing from yourself. I think that's essentially compensation and essentially skin in the game is quite crucial to the early teams of any startup company, and that's what we'd like to essentially understand very much from yourself. Moving on to business models, I suppose. Very interesting backdrop in 2019 where you have traditional players, Schwab's and all, reacting to the fintechs. I guess I'm talking more about active investing to a certain extent, with them lowering their brokerage fees and all this. But for Betterment, I guess, from your vantage point, where do you see the avenues for growth for your model? Is it in the US, or is it in the UK, is it in new products, or is it in other markets?
Yeah, so Betterment's squarely focused on the US. I think there are opportunities abroad. We've evaluated those over the years. We continue to evaluate those over the years. But we're very focused on the US opportunity. It's such a big market. You saw the slide that I put up during my talk. Yeah. We manage north of $19 billion. That's a great number. But there are trillions at stake in the US alone. So there's so much room to go. There's a lot of awareness of Betterment, but there's not nearly the awareness of a Fidelity, a Schwab, a Vanguard. So we need to continue to work to get up to those levels, because I think we're really building the Schwab and the Vanguard of this generation. But it takes time, right? I always say, the bad news about building an asset management firm is it takes a lot of time and a lot of money to do it on the consumer level. The good news is that once you get it to a certain scale, it's an incredible business to be in. Your customers are with you for life for at least a very long time, and their accounts grow. It's a negative attrition business, right? For all of our cohorts over time, if you look at them, All of those cohorts are bigger today than they were when they started because most people stick around and the markets appreciate and they deposit more to their accounts. It's a wonderful business to be in. A lot of room to grow. As we think about that U.S. market and how we become a bigger and bigger player, I think product expansion is really what we're working on the most. And if you notice, I didn't describe Betterment as a robo-advisor. I described it as a smart money manager because we've spent the bulk of this year, 2019, building out a suite of those cash management services that I talked about. So by the end of the year, you can link your Betterment to your paycheck. You can have it direct deposited into your Betterment account. We will automatically manage that flow of funds so that you have the right amount of capital available in cash. As I said, we'll optimize the yield on that cash, get you the highest yield. Have a debit card so you can go to the store and spend. You can get money out of the ATM. And then we'll automatically manage what you don't need for the near term into those long-term investment portfolios. We're really expanding from being a long-term investment manager that offered financial advice and financial guidance for things that are around the corner into being your go-to financial institution for both the near term, every day, and the longer term.
Oh, wow. Maybe perhaps you could, what are the consumer behaviors surrounding financial instruments, I suppose with respect to digital mediums that Betterment uses? For example, in Malaysia, there is still a prevalence with respect to the usage of cash, for example. I think that applies the same for Southeast Asian economies. So with the US, what is the propensity for a consumer to utilize quite a fair bit of their income, their paycheck, and to park it with passive investment schemes such as Betterment?
Yeah, so I don't have exact stats, right, but I'll, some sort of directional observations or trends. There are still far too many consumers who leave too much of their money in accounts that yield them nothing. There is a misunderstanding of the value of leaving your money in a bank account where you can't lose principal, relative to putting your money in the markets where there's risk and there's volatility. But over time, the growth is much higher, right? So people think that a bank account is riskless when I would say to you, actually, you're assuring yourself of loss of spending power over time. And you need to invest in the markets. It's the engine of growth. You just need to do it the smart, intelligent way. And again, another sort of observation is that there's still a lot of educating to be done with consumers around what is the right way to invest. Right? Should you be picking stocks, trying to pick winners and losers, timing the market? Well, I mean, there's study after study. There's so many data points that say no. When consumer investors try to achieve market alpha, they try and fail. And when they try to find active managers who can outperform the markets, once you account for fees, they try and fail. Achieving alpha, I think, is left to very sophisticated hedge funds and other institutional investors. So that's another point. And then another place I'd go is just on cash and spending.
Yes, please.
The U.S. is not a cashless economy. It's becoming more and more cashless. I think if you look at rates of ATM usage, there's probably a perception or understanding that ATM usage has been steadily declining steadily declining over the years. And it has been. Actually, though, it's quite a sharp drop off in just the last few years. And something like Venmo and other peer-to-peer payment systems has been a big accelerator of that. You don't need to exchange cash for so many of your needs. So, I use cash twice a week. Maybe that's a little bit higher.
For Subway or?
No. Subway's definitely by credit card or something. But to pay employees at home or maybe to exchange, like a dinner bill with friends, and for that even you can use Venmo. So, that's becoming less and less. I don't know when we get to a totally cashless situation, the way some maybe Northern European countries have been very cashless. And the last point I just want to make on this is debit card versus credit usage. I think it's a really interesting trend in the US, and it's creating a lot of opportunities for other fintech companies. So, credit cards have caused a lot of pain and a lot of problems for consumers who have fallen into debt in the US. And what I think is so fascinating is actually when I was brought up, so I was born in the late 70s, I grew up in the 80s, in the 90s. My parents taught me to use a credit card and use it the right way. So you're going to get a credit card. Even when I was a teenager, they put a credit card in my name, encouraged me to put some spending on it, pay off the bill, build the credit history. And you get loyalty rewards out of it, right? They taught me that was a smart way to deal with payments. Millennials and younger generation now, they are basically told to avoid credit cards at all costs. While if you use them perfectly, the benefits are really good. Just a couple slip-ups and you're way behind the curve, right? You miss 1 or maybe 2 monthly billing cycles and you pay a late fee or interest charges, and you've undone all that good. And so debit card usage has stepped up a lot, particularly in the younger generations.
It's kind of like the golden rule that we grew up with, like don't spend beyond your means.
Yeah, right, exactly. Yeah, it's like tying your hands to the mast a little bit, right? It might be, if you use that credit card perfectly, great, but you got to remove the temptation.
Right. Okay. So we've got a flurry of questions on Slido, so I really have to do justice to the audience. That's very participative and trying to angle some of those questions, some curveballs to Eli, to try and sort out. So I suppose
I could hit a curveball.
Yeah, you could. So let's try this one. The challenges you encountered. So this is a question that has 15 votes. Challenges you encountered in terms of meeting regulators' requirements in the US, and are they unbending? I suppose it's slightly controversial given the room we're in, but.
Well, so can we just clarify the question a little bit?
So the challenges that Betterment encountered when you were meeting regulatory requirements with the SEC and FINRA, like did it halt your go-to-market, and how far along?
So there was good and bad. The tough going is just the slowness. It took a long time working with our regulators, and I think it continues to take a long time. Some processes are faster than others, but particularly getting our broker-dealer license, it's really an 18-month process. Now, it wasn't all in the hands of the regulators all the time, but I had to spend, and working with outside counsel also, quite a bit of time developing really what was an application with FINRA to get our broker-dealer license. And then there was 14 months or so of back and forth with them, question and answer period, and it works on this cycle where you make a submission and they have kind of 6 weeks to either approve it or come back to you with questions, and they keep coming back with questions, and they always take 6 weeks, right? It's like it never comes back early, so it's a long cycle, and I'd love to see that cycle sped up. I think that remains the case. Again, I'm an investor in a number of other early stage startups. I have one company that I'm a board member of now that's going through an application process. It's the same thing. It's the 6-week turnaround every time. So that's trying, particularly when it's early. There's not very much capital, or like you want to go to market. The good news.
Yes.
We have a really fulsome set of rules and regulations in the US. And I think that's an advantage. It gives entrepreneurs a clear set of lines to play within. And they're not, in most cases, completely prescriptive, right? They are principled, and there have been companies that have come before us in the brokerage space, in the banking space, in the advisory space, that have applied those rules and built their businesses to fit within those rules one way. But that doesn't mean you can't innovate. You just have to play within those rules, and they're there for us to understand in advance. And I think that's far better than going into a situation where there's no regulation, that's a real wild card, right? If you look at what's happened in cryptocurrencies, right?
Yeah.
There's a lot of companies in holding patterns because we don't know how the SEC or other regulators around the world are going to treat cryptocurrencies. Or in some cases, we've seen some regulators in certain countries and jurisdictions say, you know, no more, and shut things down. That's challenging. And if you go back further in history, marketplace lenders, or what used to be known as peer-to-peer lenders, right? They, they started out really totally unregulated because there was not a clear mandate that they had to be regulated by some authority, but that was never going to last. When the banking regulators finally decided to take action, there were some setbacks in that space.
Right. Well, thank you. So we have a question as well on digital banks, I suppose. That's the topic of the day because you see a lot of introduction or legislation around digital banks in South Asian economies, such as Hong Kong and Singapore, and I'm pretty sure pretty soon Malaysia as well. So for a question to you, it is, what is the ultimate aim of Betterment? Are you looking at just becoming a digital equivalent of Schwab's and Vanguard? Or are you looking at laying a foundation for a more multi-asset class provider akin to a digital bank?
Well, listen. I mean, I think we can do something far greater than what Schwab and Vanguard have done. They've done good work in their respective domains, but I think the ultimate goal here is, we should be our customer's central financial institution.
Yes, definitely.
We should take care of all their money needs. We should make sure that we do it in the most efficient, effective means possible, so they can make the most of their money, which allows them to just make the most of the rest of their lives, and they should know that they can trust us. And that part is so important. It's something we didn't touch on in the earlier conversation. Part of the founding vision from Betterment was really about looking at the way financial services firms conducted themselves and feeling that they built product for themselves to serve their bottom lines, to generate more profits. That was, those were the sort of the design principles behind their products. And we came at it from the vantage point of, what if we design products that work as well as they possibly can for our customers, and let's take away as many conflicts of interest as we can. Let's make sure that we're always customer aligned. We actively embraced our role as a SEC registered investment advisor because that carries with it a duty to be a fiduciary to your customers, and we love that obligation. That is a centering part of our mission. That is a North Star for our customers, and it is a North Star for our employees. And lastly, transparency, right? So be as complete, as comprehensive, as hands-off and effective as possible, while making sure our customers have confidence in us, they trust us, and they know how we are making money off of them.
Right. That's amazing. Yeah, it's very good to hear. There's a moral center to essentially founding the company, I reckon, and that stems from the fact that you're not getting what you feel you're due as a consumer of financial services. Yeah, and listen, I mean that's part of an ethos that I look for in all the other fintech companies that we're working with. I want to see companies that really exist to solve problems for their customers, whether they're consumer-facing or they're business-facing, and that they're doing it in the right way. I think it's a long-term greedy approach. So moving beyond just Betterment, but perhaps your other vocation as an active investor as well, there's a question here that I think is probably asked by one of the entrepreneurs in the room. What are the fintech opportunities you're seeing in Malaysia, and perhaps are there a few you'd like to get involved with? Certain verticals, maybe someone can pitch you after the event. Let's start that conversation today. This is my first time in Malaysia. Super excited to be here. Jeff Cruttenden from Acorns and Say, he and I have been spending a lot of time in Southeast Asia over these last few months. So we've gotten a chance to visit places like Singapore and Vietnam and hopefully soon the Philippines. We've seen some really interesting companies in those areas. And we are excited to be here and excited to learn,
to hear about what you're working on. We think infrastructure is critically important. Fintech infrastructure. I talked about this a little bit in my talk. We've seen things in the U.S. that have improved account funding, account verification, security measures, back-end trading. We love to see companies working on those types of initiatives here in Malaysia and around the region, and really interested to see companies that are set up in a way that they can modularly expand from Malaysia or from Indonesia to Thailand and to the Philippines. This is I think it's a regional approach.
So it doesn't necessarily mean B2C, but it could be B2B or B2B2C.
Yeah, absolutely, right? And again, if you think about something else I mentioned in the talk, right? The economics on the consumer side and probably on the B2B side, they're going to work differently here than they work in the U.S. because of varying wealth levels, because of the scale of commerce, because of what kind of activities occur online and offline. So we have to think more creatively about how to, I think, form partnerships for reach and distribution.
So maybe just to sum up, there are quite a few questions here, but I'd like to maybe just pick on one more question and then just throw this curveball to you just before you end the session. This one question comes from a collaboration perspective with traditional financial institutions. You have fintechs who are disruptors, but you also have fintechs that are looking at collaboration or cooperation where they are collaborating and competing with traditional incumbents. So what's your viewpoint on that?
Well, to go back to what I said in the talk, I think it's been an experiment in the U.S. That has not yet lived up to its potential. And I think in brief, I think it's a place where this region can, really be the standard bearer for the rest of the world. And I think, particularly given the ambitions of some of the big tech companies in this area to get into financial services, they have reach, they have tech resources, they have capital resources, and I think that there are fintech operators, fintech founders who have expertise to collaborate with them, and that can be a really winning combination.
Okay. Just to cap off, perhaps I'd like to ask this question, perhaps because it's also something to talk about. You talk about the successes, but founders generally don't talk about the missteps. So perhaps if you're kind enough to share, Eli, what were some of the steps that you took in building the company that, in retrospect, perhaps was a lesson learned? Perhaps you could share for the benefit of founders in the room.
Right. So I talked about one earlier.
Mobile, was it?
Yeah. That was a miss, and it became an opportunity for others. Another one is probably about positioning and understanding how to market and brand a consumer financial services company. In wealth management, it's a very aspirational space, and Betterment really, we serve investors of all types. But we need people to understand that it's a sophisticated service, and that it needs to be positioned such that people with a meaningful amount of wealth can appreciate that it's the right service for them, that it's robust enough to handle their needs. You rarely find people who have maybe less wealth or more simple needs thinking, well, this is too robust for me. But you will find it the other way. So when we first came out of the gates, we sort of positioned Betterment as like a replacement for your savings account, and I think that felt like too simple of an approach. So we've learned over the years to make it, a more robust feeling brand.
So key messaging is key as well.
Yeah, I think that's right. And I think on team building, right? We did that on the fly. Right? I think seeking out a lot of mentorship from entrepreneurs who have run the gauntlet before, to understand about how to hire, how to retain, how to build culture, and how to maintain focus within your employees. That's something that is actually relatively easily taught relative to some other skills. Like you're never going to get it perfect the first time or the second time around, but there's a lot to learn there from experienced entrepreneurs, and I wished we had sought out more of that, because I think there's a lot of that to go around.
Well, ladies and gentlemen, I think we've come to the end of the session, but please join me in giving a hearty round of applause to Eli Broverman.
Thank you. Thank you. It's so nice to be with all of you.